The stock market is currently closed. DataVault Inc., trading under the ticker symbol DVLT on the NASDAQ, closed its most recent regular trading session on August 5, 2026 at 28.25 cents per share, reflecting a sharp decline of 8.9 cents or 23.96% on the day before edging back up toward 29 cents in late after-hours activity. When a stock sheds nearly a quarter of its market value in a single trading session on massive volume exceeding 150 million shares, the default assumption among retail investors on retail platforms is that the sky is falling. The consensus pitch you see on financial message boards and retail trading chats is simple. This is just another beaten-down microcap technology stock caught in a death spiral of dilution, regulatory hurdles, and speculative exhaustion. Most retail traders looking at their portfolios assume that when a stock hits new 52-week lows near 25 cents, the equity is essentially finished. But if you look past the immediate price collapse and look closely at the order flow dynamics, institutional participation, and fundamental balance sheet realignments, the reality presents a far more nuanced picture that contradicts the prevailing surface panic. The market narrative suggests that DataVault IN is merely riding the coattails of artificial intelligence hype without concrete revenue foundations. Retail investors watching mainstream financial news often cluster tech stocks into broad categories. They track massive bellwethers like NVIDIA stock for hardware dominance, Apple stock for consumer ecosystem resilience, or Tesla stock for autonomous software valuation. When a microcap name claims to sit at the intersection of enterprise artificial intelligence, data valuation, real-world asset tokenization, and acoustic data technology, skepticism is a natural defense mechanism. The mainstream expectation is that small-cap artificial intelligence companies will inevitably run out of cash, issue toxic debt, and face eventual delisting. The structural reality, however, is that DataVault IN has been aggressively restructuring its asset base, transforming its core corporate identity from its predecessor, WISA Technologies, into a specialized data sciences platform. By integrating advanced high-performance computing capabilities alongside enterprise partnerships like IBM Watson X, the firm is attempting to commercialize something traditional software firms have struggled to quantify: the actual monetary value of enterprise data assets. While retail traders panic over daily price fluctuations on their mobile screens, institutional players and strategic partners are watching whether this business model can successfully convert corporate data repositories into audited, monetizable balance sheet assets. To understand why the stock experienced such intense downward pressure during the last trading session, we have to look directly at the liquidity mechanics and recent capital raises. Microcap technology equities operate under harsh capital market conditions. When companies require capital to scale high-performance computing infrastructure and expand enterprise licensing, they often rely on direct share offerings. These offerings inject sudden equity supply into the float, creating immediate short-term selling pressure as institutional underwriters and arbitrage traders hedge their positions. The 23.96% drop was not triggered by a sudden operational collapse or product failure. It was driven by market mechanics digesting equity expansion and aggressive short-term liquidity repositioning. If you monitor trading activity on Robinhood or check order books across major individual brokerage accounts, you will see that retail volume spiked dramatically, hitting more than 10 times the normal daily average. High volume during a severe decline typically signals one of two outcomes: either total capitulation before a structural bottom or a continuous distribution phase where initial institutional holders exit while retail buyers attempt to catch a falling knife. On Interactive Brokers, the Interactive Brokers platform shows distinct blocks of high-frequency trading activity near the 27-cent support level, indicating that institutional algorithms were actively absorbing liquid inventory from panicked retail sellers. Understanding these order flows requires looking at how retail investors interact with market access tools today. Millions of self-directed investors use the Robinhood app for Robinhood stock trading, taking advantage of Robinhood fractional shares to build speculative positions in low-priced equities. Others rely on SoFi Invest, utilizing SoFi Active Investing or SoFi Stocks tools to manage high-risk allocations alongside conservative index holdings. Meanwhile, investors using traditional platforms like Fidelity, whether checking positions via the Fidelity mobile app, executing orders through the Fidelity trading platform, or allotting capital within a Fidelity brokerage or Fidelity IRAs account, often take a more conservative view on speculative microcaps. Comment below how many shares of DataVault INC you currently hold, or if you are keeping this ticker strictly on your watch list. This divergence in investor behavior highlights the tension between public perception and institutional reality. When individual traders engage in online investing or search for investment help across popular investing sites, they are frequently advised to stick to large-cap equities or automated tools like Schwab Intelligent Portfolios or a SoFi Robo-Advisor. Automated portfolio managers built around an intelligent portfolio framework generally avoid microcap technology stocks like DVLT due to volatility thresholds and market capitalization constraints. As a result, microcap stocks lack the constant structural buying support that index funds and automated portfolios provide to megacap assets. They are left almost entirely to the mercy of active traders, hedge funds, and retail momentum chasers. This dynamic creates wild price swings. Over the past 52 weeks, DataVault IN has traded in a wide range between a high of $4.10 per share and a low of 25.12 cents per share. Think about that range for a moment. A stock that traded above $4 per share now trades under 30 cents. For the average investor, that chart looks like an absolute disaster. The expectation built into a chart like that is continuous shareholder value destruction. But the contrarian perspective asks a different question. What is actually priced into a company trading at a market capitalization of roughly $250 million with a price-to-book ratio hovering near 1.3? To answer that, we have to look at what DataVault IN actually does behind the ticker symbol. Originally known as WiSA Technologies, the company built its reputation on spatial wireless audio standards and data over sound technologies like ADIO and WiSA-E. These technologies allow low-latency, high-definition audio transmission without complex physical wiring or network overhead. However, standard technology licensing in consumer audio is a tough, low-margin business with long adoption cycles. Recognizing the growth limitations of consumer hardware standards, management executed a strategic pivot. The company expanded into data management, enterprise software, and artificial intelligence infrastructure, rebranding as DataVault IN, Inc. Through its data sciences division, the firm built proprietary platforms including DataScore, DataValue, DataVault Bank, and VerifyU. These software systems are designed to address a critical bottleneck in the modern corporate landscape: enterprise data valuation. Corporations sit on vast mountains of unstructured data, but accounting standards typically treat that data as an uncapitalized intangible asset with zero official balance sheet valuation. DataVault IN uses high-performance computing algorithms and artificial intelligence agents to analyze, index, value, and securely monetize corporate data assets. Furthermore, the integration with IBM Watson X provides a compliance layer, allowing enterprise clients to calculate data valuations and pursue data monetization without running afoul of regulatory privacy standards or copyright laws. The commercial strategy involves licensing software agents, charging transaction royalties on data monetization deals, and securing recurring SaaS fees. The company is also venturing into real-world asset tokenization, applying Web 3.0 cryptographic security to verify and tokenize physical assets, intellectual property, and specialized data sets across healthcare, real estate, energy, and government operations. Yet, despite this ambitious strategic expansion, the market's current price reflects deep skepticism about execution, and that skepticism is not entirely unfounded. Operating losses remain significant, with recent quarterly filings showing substantial net losses and negative operating cash flows as the firm funds infrastructure expansion. When an early-stage growth company burns cash to build out high-performance computing systems, it must constantly raise funds. For retail investors engaged in self-investing across Robinhood Investments, SoFi Active Investing, or an individual brokerage account at Fidelity, dilution is the single greatest risk factor. This brings us back to the core expectation versus reality framework. The market expects DataVault AI